The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is regular analyst and contributor James Carlisle. Welcome, James.
Good morning.
I only call you regular, James, because we have a special guest with us today, joining us all the way. You know, being remote used to be special. We're all remote now. So, Alex, you know what? You're regular too. Joining us also is our portfolio manager for the InvestSMART Small Companies Fund, Alex Hughes. G'day, Alex.
G'day, Gaurav. G'day, James.
Yeah,
Hey.
so we're all remote, and Alex, you're in Melbourne. I don't think that should make any difference, but this is the first time I think we've had you in the podcast for a while, so it's good to have you on
Yeah,
board.
quite a while. I was actually hoping we had videos because I wanted to see Gaurav with a big beard or maybe James with a mustache.
I've been cutting my hair.
I've been shaving more often than I ever have been for some strange reason. I don't know why that is. My kids always complain about the prickly beard. Maybe
That's
that's it.
weird.
Hmm.
I've not been shaving much, but I have shaved my head. Well, not quite shaved it, but cut my hair.
Have you guys noticed the showering schedule has changed a little at all?
Yeah, it's all over the show.
All over the place, right? Yeah, nighttime showers, daytime, lunchtime showers. My schedule is everywhere.
Well, I used to mostly shower at the gym.
Yeah, me too. I
Sort of,
prefer showering at the gym. Yeah.
yeah. So now, anyway.
Yes. Well, that's the end of the point. No. We better get into some stocks. Alex, you recently wrote up a quarterly of the fund. It's been a really rough month for everyone. How has the small cap world fared? Are things looking a little bit better or a little bit worse than average in your world?
Yeah, I mean, everything is just changing so quickly at the moment. It's been an extraordinary few months. Christmas feels like a couple of years ago, and I feel like I've aged a couple of years in the last few months as well. So it's been a really testing time. The portfolio was down 25% in March, and that's our worst ever drawdown. So obviously, small companies are really hard hit in times like this. You get probably bigger impacts to the businesses, but then you also get liquidity impacts as well when essentially the whole market discovered that coronavirus was a thing. And at that point, there's this huge sorting phase that takes place where businesses that previously you thought were solvent and had a decent future, all of a sudden that's in question. And so investors might be selling stocks or adjusting the position sizes very quickly. And for an illiquid or for a smaller company, they're more likely to have less liquidity. And so if a bunch of investors decide to sell at the same time, there may not be that offsetting buying support. So yeah, that huge sort of sorting phase is probably played out, I think. You saw big trading volumes and big price moves, and that seems to have settled down. And I think some of the obvious things paid off very well at that time. You know, if you were smart enough to get out of travel, get out of retail, get out of leverage businesses, you would have done very well. And there was some very obvious buying opportunities as well. And I think for the most part, that's probably past. Everything's much more nuanced now, I think. You know, there's a lot of wreckage out there, and I think there'll be a huge amount of opportunities in that wreckage. But I think you need to think a lot harder and a lot more closely about what you're putting your money into with the price being a bit higher than the lows of March.
It was a bit indiscriminate at first, wasn't it? Whereas now everyone's sort of kind of got their heads around what's likely to be impacted, and so it's just
I don't know. Was it indiscriminate? I actually think this sell-off, one of the things that has really differentiated this sell-off for me has been the relative rationality. I remember in the GFC, everything just got hit. Gold stocks got smashed. Everything got hit massively. They're just a big liquidity exit. And here, I've been hoping for that scenario, but look at the things that have been hit hard, and they're the things that you'd rationally expect. You know, retail, anything to do with travel or moving people around. And in fact, there are lots of companies that have done well out of this whose share prices have actually risen. You know, stuff like NextDC, Macquarie Telecom. So I've been really surprised by the rationality on display here.
I
Yeah,
suppose I'm thinking of something like Ordinate which got down to 250, I think, which seemed pretty indiscriminate to me.
Well,
Not,
I don't know. I actually think that was a deserved target of selling, because when you
but why?
when you think about how their revenue works, right? They only generate revenue when their customers place their chips in the devices, and
Or
for
when they
that to
sell one,
happen,
yeah.
they need to sell a device.
Yeah, but
And you
but
and
then but they're hardly generating revenue at the moment relative to relative to the valuation and what we
sure,
expect them to eventually. Oh, look,
yeah.
I mean, look, I suppose we could
There are a few
argue
interesting
the topic
things
a
to
bit,
drill into there with Ordinate in particular, because, like as you say, their revenue model is akin to a royalty on AV
that's
equipment
right. Yeah,
sales.
that's the way you to think about
So,
it. Yeah,
big installations are probably going to be deferred, or there'll be far fewer of them in the next few years or so. But
yeah,
there's a number of offsetting factors as well, and I
mm,
don't think the market's actually across these. For instance, Zoom. So Ordinate recently partnered with Zoom, and they'll be integrating Ordinate's technology for Zoom rooms. And
mm,
Zoom's user base has just gone to 200 million.
mm,
And so that's potentially going to be a huge revenue source for Ordinate in the next few years. And I don't think many people are thinking about that at the moment, but
mm.
it's definitely something to think about.
Yeah, it's a complete change in the thesis. I mean, I've been thinking a lot about Ordinate. It's a large position for me personally, and for II, we've really gotten behind this business that is not our traditional bread and butter, and I think the big audio installations, the stadiums, the concerts, the venue revenue that's probably going to be delayed for years.
Oh,
Is my
do
guess.
you think so? I mean, I
Yeah.
think that I mean, we're banking on revenues far in the future anyway. So at the
Mm,
moment,
yeah.
the revenues are fairly low, and I think that I mean, hopefully there'll be a virus for this thing in a year. So I mean, okay, so there might be a recession, a depression, but I mean, we're talking about the share price falling from $9 to 250,
Mm,
and the valuation, in my mind, certainly didn't change anything like that.
Yeah, absolutely.
I think that in a year or two's time, there'll be just as many installations going on. Disneyland is an interesting one because they've actually brought that forward. They're actually installing the new
yeah, that's
AV
a good point.
system
That's
now,
interesting. Yeah,
Mm,
yeah.
because they've got no visitors, so it's a good
Mm.
time to do it.
Yeah, no,
And
that's a fair point.
when you also think of their competitive advantage as well, I mean, they are already very dominant in the core audio space. And I
Mm.
think it's quite likely that they won't even have competitors in a few years, because
Yeah, this is
those
a
smaller
really
ones are just going to be really struggling. But also
this
with
is
some of their new initiatives as well, because
mm,
with their video segment, the key thing for them to do now is to acquire OEMs to partner with. And so
mm.
if OEMs are not doing much and Ordinate's not doing much, that's a great time to actually win some partnerships and to build the penetration of that side of the business as well.
Yeah, I think that sort of second law order effect is where we need to be thinking. It's not just how is this business going to be impacted; it's how are competitors going to be impacted. And I've been thinking about that a lot for things like Baby Bunting and Pacific Smiles, which is a sort of a property business we wrote up in an ideas lab a little while ago. Those businesses are going to be hit, but competitors arguably hit worse, and that's the sort of second order thinking I'm trying to deploy at the moment. Alex, I was thinking that there are a couple of ways small caps could go. I actually thought they may be more flexible in their response to coronavirus. Just anecdotally, I've been thinking about the way our own business has responded. I mean, sort of, we flipped the switch, and when everyone worked remotely very quickly, and we've carried on without too much fuss at all. But talking to colleagues and friends in different industries who work for larger businesses, they've really struggled to turn over to remote working and a whole new, incorporating social distancing into their businesses. Is there a sense that this might be a reset event that lowers competitive advantages and allows smaller companies to compete better than larger ones because of their flexibility?
Yeah, I think it's hard to generalize. I think, generally speaking, smaller companies are obviously more nimble. And so if you have a smaller footprint, or you've got fewer employees or fewer divisions, you can make faster decisions and you can act quickly. So that's obviously a huge benefit. There are some offsetting factors as well. Probably the major one is access to capital. There's a huge number of businesses that are about to raise capital, and investment
Mm,
bankers only have so much time, and So they probably have to prioritize their best clients with the best assets, and small companies
Oh,
probably
you're being very generous there, Alex. I don't
yeah.
think time is what's holding those guys back. I think it's the
Well, there's only
the
so many resources at an investment bank to go around, so they prioritize the best, and small companies get
yeah.
pushed to the back of the queue. And so, instead of raising money immediately, they might raise money in a few months' time, and their
Yeah.
situation might be much worse at that point.
Mm.
And then obviously liquidity as well. That's that's another factor, a market-driven factor, which impacts the share price, the access to capital, and things like that. So I think it really depends on the business. Some can use this opportunity to be quite nimble and to boost their competitive positions, but you really just need to assess it on a case-by-case basis.
Well, here at II, our buy list has exploded. I've said before, it's probably the longest I've seen it in maybe 10 years. How has your buying behavior changed? What have you picked up and added to the portfolio that might be of interest?
Yeah, so I guess in March I added 4 new positions to the portfolio, and at a higher level, my thinking was to focus on higher quality, more liquid positions initially.
Hmm.
And the thinking there was like, obviously, this is an open-ended fund that I'm running, so I need to consider liquidity, where a mum and pop investor might not need to think about that. But obviously, when every name is marked down, I think you want to go for the best names you can. And I also think that the more
What
liquid
happened?
positions are likely to recover faster, because that's what people can actually buy. So that was the sort of the high level thinking that I used in this first phase. And so some of the businesses that I bought will be very familiar to the II subscription base. So Arb Corp was one. Altium was another that James has written up recently. Scentre Group, the owner of Westfield throughout Australia and New Zealand,
Mm.
and Auckland Airport, which is New Zealand's gateway to the world.
Mm.
I sort of think about them in 2 buckets. The first two, Altium and Arb Corp, very strong businesses. You've got owner managers in place, less likely to raise capital. They've got very strong balance sheets, and the revenue profiles there is reasonably strong. And then the other two, Auckland Airport and Scentre Group, they're asset-heavy businesses. They've got lots of debt on the balance sheet, and so capital raisings were a real risk. And my strategy going into the latter two was to buy small positions, expecting a capital raising at some point, and that played out for Auckland Airport. Initially bought a 1% position at, I think, $4.24, and then was able to participate in the placement at $4.50. So that was quite a nice way to build a position.
That's a great price for the 424. That's fantastic.
Yeah, I
Yeah,
know.
that was sort of at the height of the panic, I think.
Yeah, it's a fascinating one, Auckland Airport, to me, because it came out. We all fear capital raisings because for obvious reasons they're dilutive and all that. And in times like these, you often have to set a big discount and all that sort of thing. But Auckland Airport came out, one for 10 at a sort of 10% discount. So you were looking at about a dilution of about 1% of the share price,
Mm.
which was astonishing, really, and shows how strong that asset is really, and how much people are prepared to back it.
Mm.
Yeah, absolutely. I mean, competitively, it's hard to get more bulletproof than an airport, especially for a small nation like New Zealand, and for it to be the main gateway to the world. You're not going to build a competing airport at any stage.
But it shows that you don't need to fear a capital raising. If it's a high quality asset, then people will provide the capital if necessary.
Yeah, I mean, I think that's right. When I was buying it, everyone was already thinking about capital raisings. If you were buying it in February, no one was really thinking about it, so it was factored into the price for the most part. But yeah, I think it's a strong business. Obviously, the recovery profile is going to be quite nuanced from here, though. I think you'll probably see domestic travel come back perhaps in the next 6 months or so, but international travel is probably going to take much longer than that. And it's going to take some time before a full recovery. But with that capital raising, the risk of any debt, covenant breaches or things like that is largely off the table for at least the next 2 years.
International is the more important source of revenue, isn't it? Or they're the more important passengers. It contributes disproportionately to profit, doesn't it? Because they spend longer in the in the terminals. Is that right? That's the case with Sydney Airport, isn't it?
Yeah, that's right. They're a higher proportion of the travellers, and they're more valuable as well. So they make up a much bigger percentage of the profit than compared to Sydney Airport, for example. I think it's about 55% of the passengers are international.
Right.
Obviously, the just domestic economy in New Zealand's much smaller as well. Um, so yeah, that means it's more exposed to international travel, and so it'll be a longer recovery profile there. But it's been marked down so much. I think that's more than adequately compensated for in the price. So it's a
And
risk I'm willing to take.
it also has that property development side that people talk about a lot, which Sydney Airport doesn't so much have. Is that right?
Yeah, that's right. Because Auckland Airport's unique in that it actually owns the airport, and it also has 1,500 hectares of developable land as well. So the difference with Sydney Airport is that they have an 80-year concession, and so they actually have to repurchase the right to keep operating the airport once that's finished. Auckland Airport doesn't have to do that, so it has slightly higher margins, and I think it's um, a overall lower risk profile as a result because you actually own the land, and the debt concerns are not as great when you have that ownership. Um,
Mm.
so yeah,
So I
I think
bought
that's quite an important qualitative differentiator.
So I bought Auckland over Sydney as well. And for me, one of the attractive things about Auckland is it's just the growth profile. So that property ownership just confers on you so much optionality to grow. So and Auckland is fully aware of this, and they're exploiting it beautifully. They've got plans in place to to triple their regulated asset base over the next 10 years, and they've outlined plans to build hotels, distribution centers. There's a whole host of activity that the airport funds that earn really high returns on capital, and that you can do that for years and years and years, and they are nowhere near monetizing the airport to the extent that Sydney has already done. So they're um, a, starting from a lower starting point to Sydney, and I think the optionality to grow is far greater than Sydney as well. So it's to me it's quite attractive. And I can see why you'd choose that. But did the fact that it was New Zealand and kind of rang home have any bearing on it at all?
uh, I don't think so. Maybe somewhere in
You
my
never
subconscious
know.
that was the case,
Yeah.
but yeah, I mean, at the time when I look at them, I keep a little journal of the stocks that I buy, and it was all about the fact that, as you've just said, the regulated asset base is going to grow really quickly. You've got huge development potential. Like it's hard to actually comprehend how large 1,500 hectares is. Like
Yeah. Yeah.
it's much bigger than the Auckland CBD. So this is going to
So
be.
how much have they already developed of that, or is that all the undeveloped stuff? And so what sort of proportion of the total land holding has been developed?
Um,
It's
only,
a fraction from what I
Yeah,
understand.
only a small amount. So it's largely
Yeah.
the airport and then sort of the surrounding area. They've got a few hotels in place. There's some logistic assets, but the vast majority of that is undeveloped. So this is decades of development potential, essentially.
And it's valuable development. So they're talking about building, a integrated logistics and distribution hub at the airport, and it reminds me a bit of what Cube is trying to do at Moorebank, and yeah, and yet Auckland is doing this right at the airport, and they're in control of it. So it's almost a combination. The way I thought about Auckland a little bit, it's a combination of sort of Cube and Sydney Airport if they were both together in one spot. And you can even add hotels on top of that as well, since they're developing hotels. And sorry to go on and on about it, but the I think the regulatory asset base is really important here. The Sydney Airport earns a lot of money from its non-regulated assets, whereas Auckland, the RAB is a lot larger and it's growing quite swiftly. And that to me just confers a lot more stability on that airport.
Yep.
It's less of a sort of a retail exposed asset than Sydney is.
Yeah, that's right. Yeah, so both revenue streams have lots of growth potential for a long time. So
Yeah.
Well, geez, as I think I mentioned last week on the podcast, I went and bought both of these, and then decided that two was too many, so I sold Auckland. You're making me think I got the wrong one.
Well, Graham, who's the analyst, he goes the other way. He's made every time I talk to Graham, I think, oh, I've got the wrong one because he's
Yeah, I think they're
he's
both
really
very good at
knowledgeable
current
about Sydney,
prices.
and
I think they're both very good businesses.
yeah, I
They
think
grow
that's the
over
truth. They're
time,
both really good
but they
businesses.
have slight
Yeah.
differences, don't they? Which is interesting. Yeah.
Mm.
I mean, Auckland's slightly more expensive in terms of yield, I think, isn't it? Although
Or
at the moment it's a
the
bit
capex profile
debatable.
is much larger there. It is higher, so they don't
Yeah,
pay as
yeah,
much out in yield. Yeah.
yeah.
Yeah,
But it's also
I'd argue though that the
per
ownership
year.
of the land means it should be more valuable. Like if the two businesses had the same cash flows,
Mm.
Yeah,
Auckland Airport should be more valuable as a result of owning the land.
yeah, and I think that Sydney Airport, for an 80-year lease compared to a freehold, I think I mean, the surveyors sort of produce some charts of all this, but I think that's you'd look for about a 15% discount for that. I think so.
Yeah, yeah,
There
yeah.
are
That's what I mean. Owning the land,
yeah,
you don't have to buy that
yeah,
concession again and
yeah, right,
put that
yeah,
into the
yeah,
DCF.
yeah,
It's a reasonable
yeah.
impact over a long period of time.
Yeah, that
Well,
math is
it's
extraordinary,
more, all
actually.
the more so actually where you got some debt because Sydney Airport essentially has to spend its last 10 years or whatever, its last few years of earning, not paying any distribution at all, but just paying off that debt.
Mm.
Hmm. Alex, what else have you been? Do you want to pick one more stock, or JC? Do you want to pick one for him, and we can force Alex to talk about it a bit?
Oh well, I'd love to hear what he has to say about Scentre Group. That's one which we had a buy on a little while ago around the
Yeah.
$4 mark, and then kind of changed our minds. Mickey was the one who sort of convinced me about that. He's been quite negative about shopping centres, but
Mm.
of course, I think he had to sell it sort of above 350 or something. I mean, we're half that, or were half that. We're a little. It's bounced a bit, hasn't it? But well, yeah. Why don't you talk, Alex?
Yeah, I mean, I don't think this business is necessarily in my normal wheelhouse. I think what is similar to my comments earlier about in crises you can do really obvious things. Like to me, this was just a set of very good retail assets, probably Australia's best, really well located in communities. It was trading at 30% of book value at the time I looked at it. The trailing dividend yield was 16%. So those quantitative factors were obviously just screaming either huge problems or huge value. And just when you run through all the scenarios about how they would work themselves out of that situation, perhaps they would have to, well, they wouldn't receive any money from tenants, and so they'd have to either just write that off or get that repaid over a long period of time. And then the debt pile that they did have, maybe they could just capitalize the interest there and repay that in the future, or just keep paying that. And what would all those scenarios look like? To me, there was just such a huge margin of safety that I was willing to take that risk. And for such a big asset that's likely to get access to capital, I just thought that I thought that was a mispriced risk essentially. And so I don't think I have any special view about the asset itself. I think the internet is going to slowly erode the relevance of shopping centres, probably less slowly than some other people think. But I just think these are just good shopping centres that were just extraordinarily cheap at the time.
So
So,
if
so those
everyone's
valuation measures you mentioned were quite extraordinary. That tells me you must have bought it at a very cheap price. So what was so go on? What price did you pay? Can you
Dollar,
can you tell us that?
yeah,
You
sure.
paid $1,
Yeah, I got $1.50, which was
$1.50. Yeah, right.
yeah,
So that's
it was
pretty
about
close
the
to the
lows.
bottom.
Yeah,
Yeah, yeah. That's a great buy. Yeah.
it's
that
still
was
trading at only $2. Like I still think this is quite an interesting thing, and I think Mickey is looking at it at the moment, but he's not like these for a long time. And one of the arguments that the Bears, I should say, they actually own Scentre Group as well. I've bought a small stake, and I'm actually in there for the cap raising mostly. I think there's likely going to be one. But even without, this is still kind of interesting. So the Bears on Scentre Group say that an event like this accelerates things that are already going on, and clearly, Scentre Group, even before all this, was struggling with its tenancy. There's a lot of retailers who recognise that the cream of the profit in the entire retail sector doesn't go to retailers; it goes to the property owners, and that balance of power is surely now more likely to change, even than it was before, and it was changing before. So I think the idea that rents just go back to being what they were in 2 years ago in 2 years time is fanciful. I think the rents are probably permanently going to be lower from here. But even if you factor that in, like the prices are just quite attractive for me. So I
yeah,
concur, Alex. I think it's quite interesting.
Yeah, that's right. I
Um,
actually went to a Westfield, my local Westfield, on the weekend, I think it was, and I was amazed at how busy the place was and how many
yeah,
shops were actually opened.
yeah.
I couldn't. I was actually amazed. There was just an extraordinary number of shops operating.
And we forget that this is not just a shopping center. It's a the way I thought about it, it's just a well located piece of property, and you can really put a lot of stuff in there. It doesn't have to be struggling retail stores. And Westfield has been doing this. One of the things that has really impressed me about Westfield, above almost any other shopping center owner in the world, is how quickly they've turned over the tenant base. You go in there now, and the food areas are just enormously expanded. There's so many services. There's doctor surgeries, dental surgeries, cinemas, and restaurants galore.
Mm.
And you can see that they're able to monetize what is a well-located piece of property better than anyone else in the world. I think this is a truly great business, and yeah, well, we're trying to get. I'm in Mickey's ear all the time, trying to tell him about it. But the bear argument, I think, is equally as compelling, and for me, it's still pretty high risk.
Yeah, I mean, I think this is almost a special situation for me.
Yeah, that's like an interesting way to think about it. Yeah, okay, right.
Yeah, because I don't think ordinarily I would be looking at a business like this, but in a crisis,
Yeah,
I'm happy to.
right.
And it was really the pricing of it that brought me to it. And obviously, like, these are the best malls in Australia, I think, quite clearly. So they're probably last in line for all of the destruction to the industry that's likely to take place due to higher internet sales and things like that. So yeah, I just think that they're just more resilient than the market's given credit for.
What's difficult about Scentre Group, I find it hard to think about when I'd sell. So I even for my personal portfolio, I kind of write little notes about what I'm doing, and for my when I'd sell, I just left it blank because I do not know when I would sell this. Um, yeah, you're right. This is a special situation is probably the right way to think about it
You'd,
because
you'd, you'd have a price in mind, though, wouldn't you? I mean, that's the thing. I
yeah,
suppose with a special situation like this, you've got to have
you've
a
got
price. It's
yeah.
not something where you go in and think, look, I just think it's a fabulous business, want to own it forever.
Well, I
Mm.
think this is why it's hard to yeah, to put a buy on it, to be honest, because it's the thesis is really difficult to formulate. It's one that I just bought almost on a whim, thinking, oh, this is cheap, but it's not really a very good investment thesis just to say, oh, it's cheap.
Yeah,
You need a
I
lot
think
more than
that's
that.
a mistake though, Gorev. I think with a publication business, I appreciate that you need to be able to articulate your views in a very digestible and intelligent way. But during a crisis, I think you should have the freedom to say this is just cheap and it makes sense to buy it. We're going to make money. I think
Well, I think that's sorry. Go on.
yeah, I think you can communicate that. Just going back to the question about when to sell these things, like for me, I sort of going through a crisis, I sort of think about it in phases. And that first phase is that sorting period where everyone's just rushing to change their portfolios in response
Mm,
to the new information. And quality liquid assets are really good at that time because you can quickly sell them if you need to. And so for something like Scentre, if you can buy it cheaply and then make some money on it, you always have that option of replacing it with something. And so that next
mm,
phase of then sifting through the wreckage and trying to find something attractive again is probably going to be what leads me to sell Scentre Group. Once I
mm.
find a better alternative for the
I see.
portfolio, that'll be when I'll rotate out of Scentre.
JC, what do you think about Scentre? Have you been tempted by it at all?
Yeah, I've been tempted. Um, I think there probably is a capital raising coming, and so that puts me off. But rather, like that was my concerns about that was before Auckland Airport. Auckland Airport's changed my thinking about that a bit because
Mm,
it has just shown that how easy it is for some of these companies, with good assets to get the money if they want it.
mm, mm,
And the thing with Centre is that if you're talking about rental yields of 4% or whatever it is, you lose 1 year's earnings, 1 year's rent, and that just pushes your gearing up by 4%, doesn't it? So 1 year of rent for something like this is actually it's a pretty small bit. Um,
mm.
so yeah, I'm attracted by it, but I think that probably will have to. I say it's small beer, but it probably just takes them to the point where they need to raise some money. And I mean, I suspect there's also cash flows or EBITDA covenants, aren't there? So probably
Mm.
it's, the longer this goes on, the more likely, because those have dates where, so they might be okay on that for this 6 months, but not for the July to December 6 months. So it depends how long this goes on. Um,
And how
so
do you?
I don't know. It's a difficult one. I've been looking at it and dithering, I suppose.
Yeah.
I mean, I would say that it was on my list. I came reasonably close to buying it, but I suppose it was in the same batch as the airports, and I opted for them instead, I suppose.
Yeah. That's
Yeah,
so
I think the
actually, yeah.
recovery profile for this business is a lot clearer than Auckland Airport, at least, and many
Yeah.
other businesses as well, because it's a
Mm.
domestically exposed business. So once these
Mm.
lockdown restrictions are tapered back, we're all going to be back at shopping centres, and the picture clears up much faster than some other
Well,
businesses.
that's
Yeah, and I
interesting,
think I
actually,
think the
Alex.
thing
The,
with sorry, I'll go,
go ahead.
Sean.
Go ahead, JC. No,
Yeah,
go ahead.
the thing about shopping centres, which we've said before, was part of our buy recommendation on Scentre Group a couple of years ago, and that is that the high quality ones really do have a much better position than the lower quality
Mm.
ones, because even with retail moving online, a lot of businesses, they need a showroom essentially for their products. So Apple
Mm.
has the Apple Store where you can go and touch and feel the products. Tesla, there are numerous examples of companies that actually will still need that sort of, it's that marketplace, isn't it? It's the Roman Forum. It's the where you have that asset right in the middle of town. There's
Mm.
an awful lot you can do
Mm.
with it. Out in the burbs, not so much. But that's why, Scentre Group, I do find it quite attractive, whereas I wouldn't go near um, some of the, less well located
Yeah.
retail property trusts.
No, I agree. The 2 points I wanted to make in addition was one that the experience of China coming out of lockdown is that recovery seems to be a lot slower. People, even though new cases and all is quite low, people are very scared to gather, and shopping has not returned anywhere near to its peak. So shopping in restaurants, not quite the same as it was before. I don't know what that tells us about the Australian experience, but probably not a good thing.
Well, we're still
Um,
in the midst of the pandemic, though, aren't we? I mean, so
yeah,
the
but
point is that in a year, I mean, it depends on what time scale you're looking at, I guess.
but for China is probably a couple of months ahead. So what they do is probably instructive about what happens here. If if human behavior is uniform, which
Yeah,
I tend
I
to
mean,
think
that's
that
what gets
most
us
is.
through
Yeah,
till. That's what means it's 6 months or a year, rather than, it's certainly not going to be 2 or 3 months impact
yeah.
for a lot of these people. Yeah.
But
Yeah,
there's also these big structural problems that Centre faces. I mean, Premier Group has just said to Centre Group, "We're not paying our rent. What are you going to do about it?" Um, they just said outright. And there's a couple of others who are now saying, "We're not going to pay our rent." And I think that goes to the point that this business was probably over earning in the past, and I don't think it's going to go back to earning those old those old rents again.
yeah.
It's just taking too much of the retail pie, and
Yeah,
there's
I
going to be
think
a
there's only a
restructuring.
small number of retailers that have the ability and have the guts to actually say a statement like that. Like obviously, Solly Low is willing to do that.
Mhm.
And when you're big enough, you can actually get away with it when you can inflict some serious damage on the landlord. Um,
Mm.
but smaller retailers, I don't think they're in any position to make a statement like that. And that's the vast majority of Centre's tenants and earnings power as well. So I think you'll probably see some big retailers play argy bargy, but I don't think that would be the general experience across the board. And still, even when you factor that in, I think you can still make sense of the valuation.
But if you're if
Yeah,
you're
I think that's true. Yeah.
if you're a Premier and you've closed your store, let's say, I don't know which of its stores it's closed, but if you close your store, there's no point paying rent for the next 6 months or a year,
Mm.
just so that you can open it up in the same spot. And these things are fluid, so you'd stop paying rent.
Mm.
But I also think you'd be there knocking on the door in a year's time, desperate for them to let you back in, and
Absolutely.
with other people competing for that space. So I think the rents will come back better than people imagine, in the quality shopping centres.
Yeah, and let's say you own Centre and Solly Lou comes to your door again and wants to rent from you. Are you going to give him the same terms as you once did? I mean, for me, I'd be
Well,
thinking you have to
well, it
pay me
depends who.
more, or you're back
I
of the
think it
queue.
depends who else is knocking on the door, doesn't it? I mean, it's going to come down to competition for that space, which is
Mm.
exactly how, and that's the Westfield playbook, isn't it? They've managed that beautifully for years, and while if the demand's there, and I agree with Gaurav, it's going to take a few months, maybe a year or two to recover, but when you're valuing assets on yields of 4% or something, that a year or two of rent is actually not the bigger picture when you're talking about the asset value halving. I mean, or the market value of this asset has halved.
JC, do you want to grill Alex on any other small caps, or shall we go on to a not so small cap?
Oh, look, that was very. That's very. Which one are you talking about? I'd love to hear just quickly what he wants to
Yep.
say about Altium.
Okay.
Yeah, well, I don't know if I have any different opinion to you, James. This is obviously a great business, very strongly capitalized. It's got lots of visibility in its revenue streams with the subscription model. It does have some one-off revenue as well, and that may suffer more than subscriptions in the near term. But the main attraction here is just the competitive position and just the long-term roadmap for the business. It's been a business that I've followed for a while and have wanted to own, and so when I saw it sell off, it was one of the first on my list to have a close look and think about. So, what's going to happen over the next few years? It's probably, many customers are small businesses, and so you might see higher levels of churn. Perhaps subscription growth will slow a lot. That's probably to be expected. So you might see earnings slow quite considerably in the near term. But when you're buying a business like this, you're not really thinking about the next few years. It's really about what this business looks like in 5 to 10 years' time. And, I don't think that coronavirus is going to slow their trajectory at all. I think it's going to get stronger over time. They're going to keep innovating and improving the product, and it's going to be the logical choice for many users. And, I mean, one of the main assets they have is that human capital where people learn to use the software and become familiar with it and become really reluctant to change. And that's a tremendous asset, and that doesn't change quickly. And that's probably one of the main attractions here. So I don't think any of that is any different to your opinions on it, James, unless I'm mistaken.
No, that's right, and I suppose so there might be a bit of slowing over the next few years, and things might be pushed out, and all of that. But you were getting at one point, I think, as much of a 40% discount on the share price compared to where it was in February, anyway. So I think that's the thing with these big sell-offs is people see problems, but the impact on the share prices of some of these quality stocks can be quite disproportionate.
JC, you wrote about a recent IPO recently, and on first glance, this business has a heap of red flags all over it. So it's Dublin based. It listed in Australia at the peak of the software boom, and it is a software SaaS business. So to me, I don't even need to know any more than that. I just think dodgy overseas company that's come here to take advantage of very high prices and collect capital for a business model that desperately needs capital. And for me, I wouldn't have even looked at this. Having read your review afterwards, I thought, wow, this sounds like a really decent business, actually, really interesting. So tell us why you started looking at Fineos in the first place and how you deal with those tensions, the dubious listing circumstances against what appears to be quite a decent quality business.
Well, I first started looking at it because Nathan told me to, essentially. He came across it. I think I'm not quite sure. I think it might be in. Yeah, look, I'm not quite sure. He came across it. He asked me to have a look at it. So I got into it. And like you, the first thing I noticed is that this is a Dublin-based business, and I'm always a little bit skeptical about companies
Well,
that.
I got it from you, JC.
Yeah,
I learned that lesson from you, I think. Yeah.
yeah. I mean, I liken it to Texan oil fields.
Yep,
If there's
that's the
any
analogy
decent,
you
if
used to get
there's
me as well.
yeah, that's right. If there's any decent ones, they don't sell them to us.
Hmm.
So that's a bit the justification that management uses for selling it over here or floating it over here is that it wants to raise its profile in this neck of the woods.
That
And
seems dubious to me. It really
do you
does.
think so? Look,
Yeah,
I
I
don't know.
do.
It's important not to be too skeptical.
Yeah.
And the founder CEO has retained something like 70 something percent of the company.
Yeah.
So
Yeah.
I mean, he's also sold a decent chunk, so he's made some money out of it. But look, he's retained a large holding himself, so I don't think I don't think one can be too cynical of that. But look, I was looking at it, and eventually, there's a big problem with a company like this, which is that we can't really test its product very well. And when the valuation is sky high, it's not really due to make any profits for well, not significant profits for a little while. So you've got a sky high valuation. You've got a few red flags, and so but yet the underlying business is quite attractive. So I wanted to try to flesh out some of the details of the underlying business, and explain why I
So just
didn't
tell us
think that.
what you like
Sorry.
about it. I mean,
Well, it's
just tell us some of
got
the qualities that you quite like about it.
well, it's got a it's not got a huge market share so it sells software to help life, health and accident insurers manage their businesses essentially. It originated with claim software and it's expanded into all sorts of other areas for them. And these are areas which are mostly being done sort of in-house at the moment, or by large software companies that don't really specialize in this area. So it's ripe for a company like this to do it much better. And the signs are positive. It's been winning a lot of business. It's increasing its market share. It's the um, there is a lot to like about it. But as I explained in the review, it's important, I think, not to get too carried away with it because unlike so I made the comparison with Zero, um, and unlike Zero, it's got a very small customer base, and those are very big, powerful customers. Um, and it gets a lot more of its revenue from services, which is um, much more volatile source of revenue, can disappear in a whim. And you might think that might happen over the next year or two, but although the signs are reasonably good on that at the moment. But the most important thing is probably scalability. So it requires a much more sort of tailored approach. Its software needs to be tweaked more, and that's hence the services revenue. It needs to be tweaked more for individual customers, whereas Zero just rolls it out. So for Zero, it's all about sort of marketing. Well, it does a lot of R&D as well, Zero, but it gets to spread that over thousands of customers. Whereas Fineos is you know tweaking it more. So Zero scales much better. It can grow much quicker, makes potentially better margins, and so all of that. It's an interesting thing because when you actually look at the valuation in terms of multiples of revenue, Zero is valued about 3 times as high, but that's a multiple of revenue, you see. And when you pair that back to because of what you think the likely EBITDA margins and things like that, and Zero growing much quicker, I think it's worth that. So it's a tough one. Fineos is an interesting company, one to keep an eye on, but just doesn't quite have that sort of X factor that you need for such a crazy, well, not high valuation.
Alex, have you come across Fineos at all? What are your thoughts on it?
Yeah, I have had a brief look. I think I agree with James's assessment. This is a traditional software business, so it doesn't have the scalability and the big recurring revenue base of a SaaS-based business like Xero. I've actually had a realization recently, and I've sort of changed my thinking about these traditional software businesses. And I was looking at Hansen and Gentrack, and this is what brought me to this line of thinking. And if you look at Gentrack in particular, once used to make really great profits, was really highly valued on those profits. And that was largely driven by the one-off revenue that the business was generating at the time. And investors often get excited about the recurring revenue of these businesses, but it's really the one-off revenue that drives their profitability. And so I think the time that you should get excited about them is when you're really optimistic about the one-off revenue. And when I look at a business like Fineos, they've listed in a foreign country, and the one-off revenue is a really high proportion of their total revenue. It just makes me think that maybe they've had a good year and they've used that large one-off revenue to get a good selling multiple into the market. And it's
Mm.
hard to have a lot of confidence in the outlook for that when we don't know the business very well at all. So I'd be inclined to wait until that one-off revenue goes through a tough period when the market gets upset with the business and it has a low multiple, and to reassess it then, because with the new business we haven't seen it for a long time, and who knows if there's any skeletons in the closet. There's lots of businesses that are cheap, so it kind of makes sense to focus on the lowest risk ones at this time.
I think that's an important point, which that you don't have to buy every business. You can miss out on some businesses that, even if they do really well, you don't have to invest in all the best performers to do well. You've got to pick and choose, and it's what is it? Warren Buffett calls it the fat pitch, and I think Fineos is definitely not a fat pitch.
Yeah, that's right.
What would you need to see, James, to get into an IPO? Because I don't recall us ever really recommending an IPO. It's really rare for us to do so. This one in particular, we've talked about those flags already, but they really concern me, and it'd have to be something exceptional for me to override all those concerns.
Yeah, that's
Um,
a great question, actually. I think the main so it would need to have a good reason for floating,
yeah, I think
and
that's
it would
right.
need to have it would need to be not being sold by private equity. I mean, these are
Hmm.
ideal. Look, I mean, everything's its own situation, but for a float to look really attractive, you want the founder to be staying on board with a large shareholding,
Hmm.
and you want a good reason for moving to the next level. We need to raise a bunch of capital. I'm not selling any shares, but we're raising a bunch of capital because we want to do this with our product,
Yep.
which has got a brilliant market share in this area, and we're going to
Hmm.
take it into this area.
Hmm.
And So if anyone knows of any of those, then send them in.
Yeah, I participated in a float last year, which was a port in New Zealand, small town New
Ah,
Zealand.
yes.
So
Right.
that's a government seller there, so they've got a whole different set of incentives, largely to get
Yep.
re-elected and to make sure that
Oh, that's a good one. Yeah,
people that
that's a
buy
good
the
one.
Mm.
float make money, and also
Mm.
in private hands, you'd think the business could be run a bit more efficiently. So maybe there's some benefits once it sets off on that listed journey. So something like that, I think you can make sense of, and history suggests that government assets have been quite good floats.
Yep. Yep. No, they're both excellent suggestions. JC, I completely concur. The only reason I would buy a non-government float is there's a business with a project opportunity, and they need cash to fund it, and so they're coming to market to raise equity to fund a specific project or for a specific purpose. Yeah, all other IPOs just make me very suspicious because there's such a big information gap, and the seller's always smarter than the buyer, and the books always look very good before the float, and
Yeah.
so we ought to be very suspicious about it.
I think it makes sense to look at them though, because Audinate listed not too long ago, and if you
Yep.
looked through the prospectus of that, you would have appreciated the quality of the business, and you'd be intrigued to look further. So it always makes
No,
sense to have a quick read.
I
So I
agree.
suppose that had some of the elements that we're talking about, although the founders had sort of sold, sold out or sold on. They've still got reasonable stakes, but
Mm.
you know, uh, but they were looking to take the technology to a new level, into video and things like that. So there was reason for them to raise the capital.
Yeah, that's right. And with one of the most
Yeah,
important customers being a shareholder as well, that's quite a strong validation of the business and the product.
yeah,
Mm.
yeah. That's a good point. Yeah.
And the great thing about prospectuses is I don't think you'll ever find another single document that gives you as much information about a business as a prospectus. So for that reason alone, it's worth going through some of these just to learn
Yeah, but
about
particularly
the
about
business.
the industry, I think it's
Yes.
it's a really good sort of it contains a lot of they tend to contain a lot of information which is quite hard to find on the industry. Of course, you've got to take some of it with a pinch of salt as far as the individual business is concerned.
So I recently looked at a IPO called Carbon Revolution, and I wrote this up as an ideas lab. And this was a company that has been the first in the world to commercialize the industrial scale production of carbon fiber wheels. And you might think that's no big deal, but carbon fiber wheels, for a host of reasons I mentioned in the article, are a really attractive addition for some cars. They lighter, stronger, and so you can spin the wheel faster, so you can actually increase performance of the vehicle, but also it reduces weight. And I think the fuel consumption saving was about 4% or so, which is very similar to some of the new technologies that have been added to cars at much greater expense than carbon fiber development. And I thought that was a really interesting concept, really interesting business. Not so much for the wheels, but because this was a company that had learned how to build industrial quantities of carbon fiber. And once you've learned how to do that, you can apply carbon fiber construction methods to all sorts of different markets and industries. And they just were starting off with wheels, but I thought the opportunity was much wider than that. And I still think this is a quite interesting little business. I haven't bought it. We can't really recommend it because it looked crazy cheap, crazy expensive at the time. It's come back a long way, but it's still sitting on my radar. And I think that's one IPO that I'm going to be following for a little while. Alex, any interesting IPOs? Any other interesting IPOs on your agenda?
No, not at this stage. I think IPOs would be at the back of the queue for me when the market's really cheap.
Yeah, fair enough.
And unless they had some extraordinary features, I probably wouldn't spend much, if any, time on them.
Hmm. I feel as though we need a special effects inserted right here because I upgraded a stock that I never thought I'd upgrade. I actually don't even like this business very much at all, and no one was more shocked than me when I upgraded, and that's where we're going to have our special effect, ta-da, or some sort
Drum
of
roll. You need a drum
drum
roll.
roll.
That's it.
Actually, it was more of a sort of a doom sound because it's it's Telstra. We upgraded Telstra, which I've been scathing of this business for years, and I really there's so much in terms of culture that this business does wrong. I think it's really slow. It's at times too aggressive and other times not aggressive enough. It's the very epitome of institutional bureaucratic behavior. It's never nimble. It makes so many strategic errors, and I'd argue that there hasn't been a worse capital allocator in the top 20 than Telstra. It's just got an awful record,
When
and
was
yet
the original flow? When was it? It was sort of like early
97,
90s.
I think.
97 wasn't that T?
Or was that T2? Was it? Okay,
I
maybe it
am
was older than
T2,
that.
but
Yeah.
I mean, it's really interesting. I think how long that bureaucracy and can last in a company. Do you know what I mean? It's sold out of the it's sold into the private sector, and how long that public sector sort of bureaucracy can stay with it.
The big problem for them really has always been that they've been granted a couple of monopolies that they have not been able to let go of, and it reminded me a bit of Windows and Microsoft. Microsoft milked money out of Windows for a long time, and even when Windows was in decline, it still clung to Windows as a centerpiece of its business until the new CEO came around. And the first thing he did was he said that we are not Windows business anymore, and he kind of shunted Windows from the business, and then they pivoted into cloud and a whole host of other things. And Microsoft is now a darling and a great success story. Well,
So I suppose. Sorry, there you go.
Telstra is Microsoft before the pivot. It's just clinging on to these old monopoly revenues, and it has been doing for a long time. But I think the pivot might be coming. JC, go on.
I was just going to say, I suppose that it's that monopoly, it's that huge business strength that perhaps breeds the complacency, and
Yes.
so that's what sort of feeds the bureaucracy. That's perhaps why it's not sort of there's been no forced change until now.
Yeah, I completely agree. Yeah, and I'm not sure there has been I don't know what's forced the change, but there has been a change, and it may be that the NBN has kind of ripped away their copper monopoly, and their broadband revenues have been completely decimated because they're now a reseller of broadband rather than an owner of broadband assets. So their margin profile has completely changed. It's halved basically, and we've got a lot more competition in mobile. So the revenues are under pressure. Their margins have fallen a long way from their peaks. So I guess they've been forced to respond, and the response is actually quite a good one. So what they've done is that they've separated inside Telstra all their kind of infrastructure, physical asset businesses into one new business called InfraCo. And InfraCo holds the exchanges that Telstra owns, the ducts, the data centers, and it also very recently Telstra rolled their fiber backhaul, which is, when you have mobile towers, there's actually a fiber network that connects those towers together. And when you make calls, it often goes through the towers with microwaves. But when you're downloading data, it often gets routed through the fiber. So the fiber is a really important part of making a mobile network work, especially a data centric one. So these are great, valuable, irreplaceable assets. And then on top of that, you've got the masts, the towers that host the actual microwave equipment that make mobile networks work. And all that's being separated into a new business inside Telstra. And I think no one's actually said this, but the only reason you would do that, the only reason that you'd create a functional separation is because at some point you want to create a formal separation. So I think this is the first step into a full split of Telstra. And I think that would just release a whole lot of value. I've talked about in the
Quick
article why that
question,
might be
Greg.
the case. Yes.
Infraco, does it have external customers, and could it ever have external customers, or would it always just be the other Telstra divisions that would use those assets?
Yeah, no, I think the big upside for them is that they potentially can have external customers. So at the moment, the NBN and other people lease a lot of equipment on InfraCo assets. Exchanges and ducts get leased already, but the mobile assets, which I think are a big part of the upside here, are actually for Telstra only. And if they do get separated, there's a decent chance that the new business will be able to add revenue onto those assets by asset sharing. This has actually happened overseas. I wrote an article early last year, I think, about how the hidden asset inside Telstra is its tower network, and American Tower and Crown Castle are two businesses that have had towers separated and separately listed, and those things have just gone gangbusters because once you have a tower active, you can actually have sort of 3 or 4 different networks operating from the same tower site, and the owner of the tower becomes effectively, a monopoly property business. It just makes no sense for you to replicate the tower once the tower is already there, and they can earn really high rates of return. In fact, they are making really high rates of return. I think there are opportunities now available to InfraCo post the split. A lot has to happen before we get there, but the potential is now laid out, and I think we have to get in a bit early. Traditionally, we'd probably, as we have done for things like GrainCorp and Iluka, we've kind of waited for the split to happen and then looked at those spin-offs. I think it's going to be too late if we do that for Telstra because it's a remarkably attractive asset. So I reckon now is the time to actually go into Telstra, and you're in there for the split. Now
Sorry, go ahead.
I was going to say the infrastructure business is attractive and will be even more attractive as a standalone business, and there's ample opportunity to lift revenue there. But the split actually also improves the legacy Telstra business, the mobile and broadband business. The biggest problem with Telstra Mobile is that they are saddled with stupidly high dividend payout ratios, and it's really held the business back because the shareholders have demanded these crazy dividends. And what they can do now is they can, with a spin-off, they can satisfy their dividend-hungry investors with InfraCo, and the mobile business can be free then to reinvest and be far more aggressive against its rivals. And they've now got for the first time, they've got a decent rival in TPG Vodafone. So they'll need to be aggressive, and the split allows them to do so. So I think it's actually a decent opportunity from here. And I think the upside is quite unknown, and it may not even happen. Perhaps Telstra just wants to show the market, look, we've got these infrastructure assets, go value them. And maybe they're not even interested in a proper split, perhaps. But if they are, then I think there's tremendous upside. And if they're not, well, I don't think there's a whole lot to lose. And so I think on a risk reward, this actually starts looking quite attractive. I never thought I'd be upgrading Telstra, and yet here we are.
Just a quick question, Grove. Oftentimes, the people are a great qualitative indicator of, a good business. The people that have been appointed to run Infraco, would you say that they're the cream of the Telstra crop?
Well, so far, we haven't given too much information about that. The company is going to give an additional update. I think it's in June or July this year, where they give a breakdown of the assets inside Infraco and presumably a bit more information about who's going to be heading it and who's going to be inside that business. So I think that's going to be quite instructive. And again, I wanted to get insight into Telstra ahead of that. I think sometimes if you wait for too much certainty, the opportunity disappears. And so I wanted to get in there while the outcome was still uncertain. But yes, you're right, Alex. That's a really good indicator, and I think we'll get some more information in the next few months about that. Right. Any other questions on Telstra? I can see you both are gobsmacked, speechless that we got this thing sitting on our buy list. Alex, what do you do from here? Do you have any other pressing buy ideas at the moment that you're going to run off and execute, or is this a time to be just sitting back and watching?
I was actually just looking on LinkedIn about Infraco's people. Brendan Riley is the CEO. I've just looked up. You can find all that stuff there. In terms of next stages, well, I think it's more of the same, really. We're just trying to find good things to buy, good assets that are trading cheaply. It's much more nuanced from here on in, so you've got to do a lot of digging. The things aren't as obvious as they were perhaps a month ago. But I think there's still great opportunities out there, and it's going to be a great time to deploy some cash. So I'm quite excited about what the future holds.
How much cash have you got at the moment?
I did decide to participate in the Webjet capital raising. I left that to as late as I could, but the spread was so great that that will consume more of my cash. So it's down to about 15% now.
Oh, that's still pretty. That's still some good ammunition.
Yeah, that's right. Like I am anticipating a number of capital raisings, which will consume some, and probably, because this is an open-ended vehicle, so I do need to retain some cash, and I am conscious that investors in the fund have their own needs for cash as well, and they might need to redeem in order to fund certain things going on in their lives. So I need to be conscious of that. And how I think about the overall cash balance. But yeah, we certainly still have plenty of firepower left.
Terrific. Well, that means we'll be chatting again once you've bought some more stuff, and we'll exchange ideas. JC, thanks very much for joining me today.
Pleasure.
And Alex, great to have you on board again, and hopefully we can catch up more often.
Yeah, absolutely. Thanks to both of you, and hopefully we can have the video on next time.
Yeah, I don't know about that. I'm not that keen. I don't want to be looking at either of you while I'm talking. Everyone else, thank you for listening.